Well, the oil supply shock is likely to weigh heavily on South Korea's current quarterly growth, as its GDP contracted in the final quarter of last year at a slightly slower pace than originally estimated. The contraction taking place because of weaker investment and exports. It follows a sharp expansion in the third quarter, when the government rolled out stimulus policies to boost domestic demand. And for more on the latest impact of oil prices on South Korea, we're joined by Krystal Tan, who is an economist at ANZ. Krystal, South Korea's GDP data, that came before the oil shock. So how much could soaring oil prices drag that down in the current and coming quarters?
Well, the increase in oil prices does present a material downside risk to Korea's growth. The thing is, Korea is highly sensitive to an oil shock, given two structural features. One, it is highly reliant on imports, given its energy needs. And two, the Middle East is the one that typically supplies a dominant share of those imports. So the situation we have now is that Korea is facing a shock in terms of its energy import bill, and that's going to feed through to domestic costs.
Yeah, we know the country imports nearly all of the oil that it consumes. So when prices spike like this, which sectors of the economy do you think are likely to feel that pain first?
Well, the most vulnerable ones would be the ones that, the cost shock pass-through is fastest, right? So this would include transport and logistics. For this sectors, fuel is a first order input, right? And fuel prices have surged. Energy-intensive manufacturing sectors like petrochemicals, like steel, those are also exposed because higher energy costs are coming at a time when they are already struggling with weak margins, right? And this higher cost is just going to compress margins further. Now, aside from the price shock, the petrochemicals sector is also facing some production disruptions because the Middle East is also a dominant supplier of naphtha feedstocks, right? So the delayed deliveries of the things are actually causing some firms to have to cut back their run rates.
Well, meanwhile, we know that Seoul has introduced a fuel price cap. That's for the first time in nearly 30 years. Will that meaningfully cushion the consumers, or could it also distort the market and then create new problems down the line?
Well, yes, the government has signaled plans for a fuel price cap. The idea is to try to cap excessive pump price increases. Now, the actual price is probably going to be linked to global crude prices, and it also has scope to be adjusted for every 2 weeks. So it's more of rather than a blanket fixed price, it should be seen more as a dynamic upper ceiling. There are also other measures actually that the government could potentially consider to try to cushion retail prices. So for example, they could also expand some of the fuel tax cuts that are in place. Those will also help limit the immediate pass-through to headline inflation.
Yeah, and meanwhile, if the oil prices continue to push towards about $150 a barrel, say, what would that mean for South Korea's inflation outlook this year?
Well, if oil prices are high for a long period, that would certainly raise inflation quite significantly, right? So we are already seeing the first order impact. We've seen domestic fuel prices adjust significantly. They're up something like 10% over the average February levels. Now, if these prices remain elevated for longer, what we're going to see that the next round effect is going to be that higher energy cost is going to feed through to production, it's going to feed through to logistics, it's going to feed through to services pricing. We're going to see a broader range of goods and services face upward price pressures. And then if inflation expectations also start to lift, then we're going to have a bigger inflation problem.
Yeah, and speaking of that problem, the central bank then faces quite a dilemma. It can raise rates to fight inflation or perhaps support growth in a slowing economy. So which risk is actually greater right now?
So look, when we look at oil prices, currently the immediate near-term risk is some upside to inflation, some downside to growth. So I think the immediate reaction function for a central bank is typically to look past the immediate supply shock to see whether it's transitory or if it's something more persistent. So the key thing to watch really is, one, inflation expectations, and two, the Korean won. Because if the Korean won weakens, that is only going to amplify the imported inflation pressure. So if you have both inflation expectations rising, you have your won weak, then the central bank is going to be constrained even as growth slows.
Yeah. Well, Krystal, very quickly before we go, beyond the immediate crisis measures, what are some short-term or longer-term policies that could help South Korea to reduce its vulnerability to these energy shocks?
Well, in the near term, we've already discussed some of the policy measures, right, on prices. They're looking at fuel price caps. They're looking at potentially fuel tax reductions to help limit the inflation pass-through. Now, there's also some scope for fiscal support. This would likely be targeted towards more vulnerable households and also to more vulnerable businesses. But over the longer term, I think the focus really has to be on reducing oil intensity in the economy. And there are actually multiple multi-year frameworks that are in place, right? On the security side, Korea does have a very large strategic buffer. Now, on diversification, there's actually been some progress at the margin. The share of imports from the Middle East has actually fallen in recent years. I mean, the dependency is still structurally high, though, and that's partly because of long-term contracts and also refinery configurations. These things do make switching costs costly and also slow. And well, longer term, the goal, of course, is also to reduce dependence on fossil fuels. So on that front, Korea's long-term power planning targets do include raising renewables capacity, right? So way to reduce your exposure to oil price swings. There's also a push on the demand management front. So things like, accelerating high efficiency appliances and industrial upgrading so that, you use less energy per unit of GDP.
Krystal, thank you so much for sharing your insights with us. That was Krystal Tan, economist at ANZ Singapore.